Good morning, everyone. Our topic for today is equity investment, dividends, share split, and share right.
Investments refers to the assets or items being acquired by the entity with the goal of generating income or appreciation. Investments in equity securities are accounted for as one of the following categories. First is trading securities or financial assets at fair value through profit or loss, meaning the entity buys the shares of another entity which he has a purpose to trade or to also sell that shares he bought in the near period of time. Second is financial assets at fair value through other comprehensive income, meaning the entity buys the share of another entity which he has a purpose not for trading or selling, but for him to be able to earn the dividends. Next is investment in associate. In investment in associate, this is like category number 2 which the entity has a purpose to earn dividend but to the extent that the investor have the significant influence in that company. The fourth is investment in subsidiary. It's like category number 2 also, but the difference is that the investor have the control in the company. Then the last one is the investment in unquoted equity instrument. The unquoted entity instrument will be used if and only if the fair value is not available. If there is no share value given, then the classification of investment will be the investment in unquoted instrument.
Sale of equity securities. When equity securities are of the same class acquired on different dates at different cost, a problem will arise as to determination of cost of securities sold when only a portion of these securities is subsequently sold. In such case, the entity shall determine the cost of the security sold using either the FIFO or average cost approach. Dividends. It is a distribution to shareholders of cash, property, or stocks from unrestricted retained earnings on the basis of all issued and fully paid shares and all subscribed per value shares except treasury shares. Simply means that dividends is a distribution of your assets and non-current assets. Since the corporation distribute to shareholders, therefore they are expecting there is something they can receive. But at this point, it is a distribution of cash, property, or stocks came from retained earnings, and it must be unrestricted. We all know that there are two types of earnings. It consists of unrestricted and restricted. But since it is unrestricted, the shareholder will receive dividends. The question is, which the shareholder can receive the dividends? It is said that on the basis of all issued and fully paid shares and all subscribed per shares, meaning to say, all the shareholder will receive dividends except the treasury share. Cash dividend. A cash dividend is a distribution of funds or money paid to stockholders generally as part of the corporation's current earnings or accumulated profits. Cash dividends are paid directly in money as opposed to being paid as a stock dividend or other form of value. When we are going to enter the cash dividends that are already earned but not yet received, dividend receivable will be debited and dividend income will be credited. But when the cash dividends are subsequently received, cash will be debited and dividend receivable will be credited. Dividends considered earned. So here are the three types of dates for able to us to consider that dividends is already earned. The first one is date of declaration. Regarding on this date, we can only consider that dividend is earned if it is approved by the Board of Directors. At this point, it only occurs if the Board of Directors announce the meeting or declare for the distribution of dividends. The second one is date of record. Here is the date of record. It only occurs when the shareholder received the dividends distributed by the Board of Directors. Therefore, only the shareholders are entitled on this. Since the shareholders are registered on that day, they have the right for receiving the dividends. And the last one is date of payment. This is the date on which the dividends declared shall be paid. The question is, who has the obligation or duty to pay the dividends? Since the shareholders are the one who receive the dividends, therefore, still the original shareholders have the right for that payment. The dividends or dividends in kind are dividends in the form of property or non-cash assets. It only happens if the corporation don't have any cash dividend to distribute to shareholders. Instead of cash or stock, they would be given the property dividends. Property dividends is considered as income and recorded at fair value. If you are going to enter this property dividend, we're going to debit non-cash assets are called the property dividends and credited dividend income. Example of property dividend. X company distributes its holding of 10,000 shares in Y company as property dividend. The shares of Y company have a market value of 100 per share. A shareholder received 500 shares of Y company as property dividend from X company. Since the shareholders received 500 shares from Y company as property dividend and then X company distributes his share amounted to 10,000 and having a market value of 100 per share from Y company, the entry will be investments in share. It must be debited amounted to 50,000 because 500 share multiplied by the 100 per share. After that, dividend will be credited. Liquidating dividends, it is a distribution of cash or other current asset to shareholders with the intent of shutting down the business. This dividend is paid out after all creditor and lender obligation have been settled. So the decided payout should be the one of the last action taken before the business is closed. Here is the example. A shareholder receives a 100,000 dividend, designated as income 60,000 and liquidating 40,000. Since you receive 100,000 dividend, your cash will be increased and it will be debited. And also dividend income amounted to 60,000 will be credited for showing that dividend income will increase also. And investment in shares amounted to 40,000 will be credited also. Dividends or share dividends. When we say stock or share dividends, it focuses on equity. Those dates that I mentioned above, including date of declaration, date of record, and date of payment, are very important because when we are going to enter the stock or share dividends, identifying date is included. But from the knowledge of everyone, stock dividends payable are not a liability but rather than an equity. Dividend is also a payment to shareholder that is made in share rather than a cash.
Kinds of share dividends. First is the share dividends of same class, which is recorded only by means of a memorandum entry on the part of the shareholder. The memorandum entry refers to a short message and it is not a complete journal entry because it does not contain debit and credit amounts. In the example problem in the book, a shareholder owns 10,000 shares costing 120 pesos each or a total cost of 1,200,000. Subsequently, the shareholder received 20% share dividend or 2,000 shares. Then for us to be able to get the share now held, we only just need to add the original share amounting 10,000 and the share dividends which is 2,000 and will give us the sum of 12,000. And the cost per share which is given in the problem, then the total cost which is 10,000 multiplied by 120 is equals to 1,200,000. Then for us to be able to get the adjusted cost per share, we just need to divide 1,200,000 divided by 12,000 to get 100 for the adjusted cost per share. Then the memo entry for the receipt of the share dividends is received 2,000 shares representing 20% share dividend on 10,000 original shares held. Shares now held is 12,000 shares. Share dividends do not affect the total cost of the investments but reduce the cost of the investment per share. The second one is share dividends different from those held. A shareholder may receive a share dividend which is different from the original shares. Take note that share dividends, whether of the same class or different, are not income. The reason is that there is no distribution of assets of the entity. However, the original cost of the investment is distributed between the original shares and the share dividends on the basis of market value of each at the date of receipt. So before we proceed to the example in the book, let's differentiate first the ordinary share and the preference share. So ordinary share refers to the basic ownership in the corporation, while the preference share is having a certain advantage over the ordinary shares, or it's like VIP. For example is a shareholder owns 10,000 ordinary share costing 800,000 pesos. Subsequently, the shareholder receives 10% share dividend in the form of preference shares. The market value of ordinary share is 150 and the market value of preference shares is 100 pesos. Then the original cost of 800,000 pesos is allocated as follows. For us to be able to get the market value of the ordinary shares, which is 10,000 multiplied to the market value of ordinary share, which is 150 pesos, will give us the product of 1,500,000 pesos. Then to get the preference shares, the ordinary share, which is 10,000 multiplied by 10% is equals to 1,000. Then multiply to 100 pesos, which is the preference market value. Then it is equals to 100,000 pesos. The fractions of ordinary share is 15/16 and the preference share is 1/16. To get the allocated cost, the fraction which is 15 divided by 16 multiplied by 800,000 is equals to 750,000, and for the preference shares, which is 1 divided by 16 multiplied by 800,000 is equals to 50,000. Then to record the receipt of preference share as share dividend on the ordinary share investment is investment in preference share, which is 50,000 on the debit side, and credit side of investment in ordinary share, which is 50,000. Share received in lieu of cash dividends. When cash dividends are declared or received, it is without doubt that they are income. A problem will arise when shares are received in lieu of cash dividends declared. It is generally accepted that shares received in lieu of cash dividends are income at fair value of shares received. The reason is that such shares are in effect of property dividends. In the absence of fair value of shares received, the income is equal to the cash dividends that would have been received. To record the receipt of shares, debit the investment in shares, then credit the dividend income. Cash received in lieu of share dividends. When share dividends are declared and received, unquestionably they are not income. A problem will arise when cash is received in lieu of share dividends. So it is the opposite of share received instead of cash dividends, and it composed of two approach, the as-if approach and the BIR approach. First is the as-if approach. This means that the share dividends are assumed to be received and subsequently sold at the cash received. Therefore, a gain or loss may be recognized. Then the next one is the BIR approach, or the Bureau of Internal Revenue approach, which is all cash received, whether originally designated as cash dividend or share dividend, is recognized as income. However, the as-if approach is theoretically sound and should be followed for financial accounting purposes.
Share split may consist into two, split up or split down. When we say split up, it is replaceable by a larger number, or in another word, if I share 10,000 and the share is split up for 5-for-1, the shareholder received 50,000 new shares. But if 5-for-1 change for 4-for-2, the new shares that shareholder received will also change as exchange for the 10,000 original shares. This is split up. There is also a split down, which is the reverse of a split up. If the former split is the transaction whereby the outstanding shares are called in and replaced by a larger number, this one is also replaced by a smaller number and increased in the par or stated value. If you, as the shareholders, owns 10,000 shares and is split down for 5-for-1, it means that the shareholder received 2,000 as exchange for its original shares amounted to 10,000. When we talk about special assessment, it refers to the additional capital contribution of the shareholders. It can be seen when someone are required to pay tax or the fees. So on the part of the shareholders, special assessments will be recorded as additional cost of the investments. So here are the example of special assessments. A shareholder owns 10,000 shares costing 500,000. Subsequently, the directors pass a resolution to the effect that the shareholder shall contribute 5 pesos for each share held to the corporation. Since the shareholder paid the special assessment, it will be recorded as follows. Investments in shares amounted to 50,000 will be debited and cash will be credited.
Share right is the right given to the shareholders to purchase new shares, wherein the corporation's priority is the shareholders. If there's new shares, the corporation will offer first the new share to the shareholders before selling or offering it to other entities. And it is also called as right of first refusal. Then the preemptive right is preventing the percentage of your shares to decrease. The purpose of this share right is to give the shareholders the chance to preserve their equity interest in the corporation. So let's proceed to the date of declaration. The date of declaration is said to be the date which the corporation declared that they will give share right, which is basically represented of share warrant. The share warrant are the documents or papers like a proof that you can buy a share before they offer it to others. Then the date of record. Date of record is the date which only those shareholders registered as of the record date are entitled to receive the share rights. If you sell your share at the date which is between the date of declaration and the date of record, it is considered as write-on. In other words, the share cannot be sold without also selling the right or vice versa. Then if you sell your share in between the date of record and expiration date, the shares are said to be the selling ex-right. This means that the share can now be sold separate from the right or vice versa. Accounting for share rights has two types, but PFRS 9 does not address this accounting issue categorically. First is share rights are accounted for separately, and the second one is share rights are not accounted for separately. Let's proceed first for accounted for separately, which shall be measured at fair value at the acquisition date. In other words, a portion of the carrying amount of the original investment in equity shares is allocated to the share rights at an amount equal to the fair value of the share rights at the time of the acquisition. When share rights are issued, the investor is now the owner of two financial assets, namely original shares and related share rights. To record the entry for accounted for separately of the original investment, debit the investment in shares, and credit the cash if the entity bought the share in cash. For the receipt of share rights, debit the share rights and credit the investment in shares. Note that the original investment account is credited when the rights are received because the share rights are derived from the original investments. Then when the share rights are exercised, the entry would be investments in share debit, then credit the cash and the share rights. Then if the entity sell his share rights, the entry would be debit cash, then credit share rights, and then credit the gain on sale of share rights or the loss. Then for the expiration of share rights, debit the loss on share rights and credit the share rights. Then the second one is theoretical or parity value of share right. From the word theoretical, it means that being assumed or the assumed fair value of the right that is derived from the market value of the share. There are two formulas may be used in the computation of theoretical or parity value of the right. The first one is when the share is selling right on, the formula would be market value or fair value of share right on minus the subscription price over number of rights to purchase one share plus 1 equals to value of one right. Then when the share is selling X right, the formula would be value of one right is equals to market value of share X right minus subscription price divided by number of rights to purchase one share. Next is not accounted for separately, which uses memo entry. And to record the investment, debit the investment in shares and credit the cash. Then to record the receipt of the share rights, you will only apply the memo entry because you only receive and given the right to purchase the shares. And to record the exercise of the share rights, debit the investment in shares and credit the cash. If the share rights are not exercised but sold, the sale is simply recorded by debiting cash and crediting the original investment account. No gain or loss is recognized from the sale. But if the share rights are not exercised but expired, only the memorandum is necessary to record the expiration.